classically speaking, I mean, I'll probably be better classified as a deep value investor, right?
If there's one active investment strategy you should learn about as a risk-taking retail degenerate, it's this one. Not just like fuck it risk, your usual strategy, but asymmetric risk. Risk that actually wins with positive expectancy. What is deep value investing? What advantages does it offer you as a retail trader? And how did deep fucking value use this strategy to make tens of millions of dollars? It's literally written into his name. Ray Dalio said, "You have to be an independent thinker in markets to be successful, because the consensus is built into the price." If we want to learn about the ripe deep value opportunities that exist every day, we have to visit a more interesting area of the stock market. Deep below the mainstream analyst coverage, below Amazon and Facebook, there's a whole other world that exists. Plastic manufacturing companies, silverware distribution logistics firms, fraudulent accounting practices, and sketchy illiquid options. I can't guide you through this strange world. There are other shamans who do that. I'm just the translator. But why would you venture into this uncharted territory in the first place? There's plenty of money to be lost up here in the safe zone. In short, it's because some of the greatest opportunities lie where no one else is willing to look. By no one else, I mean there's still a lot of people looking down here too. In the large cap universe, there's less unrecognized value to be unlocked. A lot of these companies are experiencing the temporary periods of peak performance before competition emerges. As humans, we also tend to extrapolate growth and decline trends linearly. Amazon will keep growing forever, GameStop will keep sucking forever. Wait. And now it makes sense. If we want to understand deep value, we have to shift our definition of what value is. After all, most of you have probably heard people say that value has underperformed growth for decades. So what really is value? When I'm talking about value in the context of DFV's strategy, I'm not necessarily talking about discounts between price and intrinsic value. With a lot of the companies he's looking at, there's so much uncertainty about the future that estimating any kind of accurate intrinsic value can be very difficult. In one of his videos, he claims,
"Many people think that it matters like getting an accurate valuation, right? But that's ridiculous. Like, no one cares. Who cares? No one cares if you can accurately value a stock, which is, I mean, you can't even get an accurate, precise value, right? That's ridiculous." But
I really like this idea of nobody caring about valuations. When using a strategy like his, you're often dealing in companies with low liquidity, no analyst coverage, no real mainstream marketing that attracts attention. This is a blessing and a curse. It means you might find real discrepancies between price and value. But really, what's the difference if no one knows or cares? Value-based investing strategies tend to perform well when there's more turnover and churn in the market. Companies frequently falling out of favor, then making a resurgence. In recent years, we've seen more winner-take-all economics. People think this is one of the reasons why value has been underperforming. That's why I really like his idea that pure value isn't a driver for above-market returns.
what matters is incorporating those values into a framework that you can leverage over time to profit, to outperform the market. I mean, that's what matters. So unless you have it's the framework that matters.
But does he have a framework that really works? Was GameStop just a lucky win? I went back to the oldest uploaded stream on YouTube that allows us to see his portfolio. Let's take a look at the top 10 biggest positions in his portfolio. How have they returned since this video? So there's only 2 positions that haven't at least doubled since July 13th of 2020. Beyond that, I'm guessing he bought most of these closer to the pandemic sell-off, which means he probably owns them at a much lower cost basis than the price we see here. Basically, just adjust all of these returns even higher. Safe to say whatever framework he's using is good. Very good. Better than the framework I use, which returns negative 50% per month. So what is that framework? There are a few staples of deep value opportunities that we need to consider. We'll then look at some of the practical strategies DFV uses to uncover these opportunities. So as we descend into uncharted waters, what are the common traits we're looking for? Clustered insider buying. DFV weighs this very heavily in his analysis. Insiders might sell their shares for any number of reasons, but they buy them for only one. They think the price will rise. Insider buying from multiple executives is a great vote of confidence. Who would know better than a company's management team where the share price is going to go? You can check for insider transactions using a website called Open Insider. The more green you see, the better. This isn't really enough to be indicative of anything. Ideally, you'd like to see cluster buying with higher volume. 3 to 5 executives buying upwards of $200,000 worth of shares each is a great indicator that insiders think the share price is about to move upwards. Looking at DFV's top position from earlier, we can see that during the COVID sell-off, multiple insiders started buying up their discounted shares. And as you can probably guess, it worked out pretty well for them.
I'm often investing in leveraged companies, but I'm trying to assess them. So I'll spend a lot of my time assessing credit risk, right? What's the likelihood of this company going bankrupt in the near term? And if not, could it survive and thrive and all that stuff, right? So
when you're shooting for 50 to 100% returns per year, you're going to have to get good at dealing with some risky companies. Stocks with a sizable value discount are usually priced that way for good reasons. I'm not going to bore you with solvency ratios in this video. Instead, if you want to learn about the boring but equally important parts of this strategy, like analyzing credit risk, I'm doing a full deep value-esque analysis on my Patreon. All of the money you pledge gets donated to Wall Street in an account where I test out different strategies. Right now we're looking for some deep value opportunities on there. The link is down in the description. The one credit risk measure we can talk about is the yield on a company's publicly traded debt. So a company issues bonds to raise money. Those bonds are given a rating based on how safe they are. The more safe they are, the lower their interest payments or yield. A higher interest payment means a bond is more risky and vice versa. A bond's yield is also inversely correlated with its price. When yield goes up, price goes down. When yield goes down, price goes up. There are two places you can go to look for useful credit information. The first thing you can do is look up company ticker credit rating. You might have to sift through some irrelevant information, but it's usually not too hard to find a rating. Another thing to keep in mind is that the actual ratings are usually not as meaningful as the reasoning behind the rating. So any credit analysis you can find from ratings agencies is the really beneficial part. The other thing you can do is see if the company you're researching has publicly traded debt. If you go to the FINRA bond lookup, you can search to see if a company has issued publicly traded bonds.
That's when you're really digging deep, and you just need to assess, is this company going bankrupt? Can it survive another year? Because that's when you make the most money. When perceptions go from the company's dead to, oh shit, maybe it's going to survive another year or two, and then boom, 3x, 4x overnight.
DFV describes the verge of bankruptcy as often being a ripe opportunity for an investor like him to take a risk that's asymmetrical to the reward. As the business runs smoothly over its lifetime from an operational perspective, we're trying to find companies that, despite falling out of favor, still have financials that would indicate a track record of good performance. Basically, their share price is depressed because of external market factors instead of poor decisions from management. I think one of the best places to do this is a website called Ticker Terminal. If you go to sign up, they say they'll put you on a wait list, but I found that it only took them a few days to give me a free account. In here you can see you have access to every financial ratio you could ever want. When you get excited by actual financial ratios on a screen, that's when you know you're in way too deep. The nice thing as well is that it's laid out very visually, which I think makes it a lot easier to understand. It reminds me of the colored pencil artwork I usually do for my analysis. This is when the real due diligence comes in. So the company's trading at a low valuation? Why is it trading at a low valuation? What was happening in the world when it was doing better before? Does that thing happen in cycles? What's management's plan to survive? Do other people think this plan might work? Just make sure to take an extra Adderall coffee when you do this. How might all of these criteria fit together into a systematic approach to investing? If we had to simplify DFV's strategy into a formula, what would it be? Well, unfortunately, you really can't. He even says it himself.
And then at this point in my career, a big part of my process is just feel. I can't really boil it down to strict buy and sell criteria. And believe me, I tried. I mean, I feel like all value investors try to do this checklist and everything like that.
If it was easy to quantify a deep value investing approach, every opportunity would have been arbitraged away by quants on Wall Street a long time ago. So in a sense, the fact that it's complicated is a good thing. Markets with lower liquidity and less analyst coverage can bring rise to big opportunities if you know the right places to look. Once we find these opportunities, what are the strategies we can use to capitalize on them? DFV claims that he's always on the lookout for attractively priced long-term call options. In the small cap deep value markets, options tend to be overpriced to compensate for the sporadic movements of share prices. When looking at a small cap options chain, just apply the same critical thinking you would usually use. Hopefully not that. You know what? Just stay away from sketchy, illiquid, overpriced options. They introduce unnecessary risk on top of the risk you're already taking. Buying shares in 99% of cases makes a lot more sense. How many different positions should we hold in our portfolio? Around 15 to 20 usually makes sense. That being said, more diversification will never hurt you in a portfolio filled with a lot of companies on the verge of bankruptcy. What have we learned? If you want to learn to trade like the legends, you're going to have to learn to train like the legends. And Unfortunately, this isn't some Mr. Miyagi cool training. Your training consists of reading financial statements, analyzing credit risk, and just doing a lot of things that are probably going to temporarily make you hate your life. Is it all worth it? To hit multi-baggers like this? And this? I'll cut my own arms and legs off to do that.